Wow, it's a lot of people out there. Good morning, ladies and gentlemen. It's a distinct honor today to be your keynote speaker. I'd like to address an opportunity. And that opportunity is a greater collaboration across the spectrum of lessors, financiers, OEMs, MROs, and the airlines themselves, and advisors like ourselves. And I'd like to explain that in some detail along the way. But first, I want to acknowledge who's here. We couldn't pay for the whole screen, so we only got a little screen over here. So assembled here are some 1,700 people representing airlines around the world, OEMs, MROs, lessors, financiers, and a few advisors like Seabury sprinkled in. We're here at a unique period of time, as I'll explain early on in the address, which is that we have substantial profitability, something that has been a fairly rare phenomenon in our industry for many years, leading to many jokes along the way. But I believe now is not the time to be complacent. Indeed, as we'll discuss later in this presentation, we're still a long way from earning our way on a global basis. What we do see is substantial profitability in North America, which has been lacking for decades prior to this past decade. And at the end of this address, I'd like to throw out a challenge to the assembled people here and your colleagues around the world, which is to focus in on how and when we can collaborate. And I'll give some case examples of where we've collaborated. Indeed, Seabury Group, which I founded June 1st, 1995, so we're coming up on our 20th anniversary. We've done an extraordinary amount of working together with the people in this room and your colleagues around the world. We've executed over 1,100 engagements involving a lot of very difficult turnaround situations for airlines, and I'm going to talk about the importance of those turnarounds and what they've done for our industry. And I'm specifically going to talk about how to avoid them, because the objective here really is to preserve capital and grow capital for the industry, whether you're an airline, lessor, bank, OEM, MRO. And indeed, 95% of the 300 people around the world that work for Seabury do something other than restructuring, which seems to always be something that is a novel idea or a concept when I talk to a lot of the people around this room or your colleagues around the world. What we do today is build software systems that power some of the most sophisticated flight profitability systems in the world for 3 of the 4 largest US carriers: Delta Airlines, American Airlines, Southwest Airlines. We build very sophisticated revenue network fleet optimization models that are used by many airlines around the world. We're the biggest cargo database and the biggest cargo advisor group in the world, both for air and maritime shipment. We do a lot of human capital work, a lot of other things. And of course, we have a lot of very good competitors out there doing the same thing. What I'd like to talk about today is your importance. Whether you're an airline executive or someone providing capital or selling aircraft or engines to those airlines, why it's important for you to be a participant in that process. But let's first turn our attention, and I realize you can't probably see this, but we have a unique situation here where with substantial profitability and much better profitability performance in the last 5 or 6 years, airline equities have been bid up. They're roughly 25% higher than they have been as recently as 5 years ago, regardless of which measurement you're using. And what's the corollary to that? Well, the corollary to that is that lessors and OEMs share prices have also gone up. So it's a symbiotic and very powerful relationship that we all want to encourage. But there are some warning signs. The global recovery that has powered this recovery is not, in fact, uniform. The US, China, and India continue to grow. UK doing pretty well. But as you look elsewhere, certainly in the Eurozone, certain parts of Asia, and certainly Russia in particular, there are signs that this demand growth that has been driven by recovery has some weaknesses. Globalization itself is in question as to how strong of a motivation or how strong of a force it will be as we look over the next 20 years. This chart demonstrates the relationship, and I have to credit Brian Pierce, the chief economist of IATA, who first showed this chart at another conference I was at. It is a calculation of U.S. international trade divided by U.S. domestic industrial production. As you can see, it has had a long trend in the positive direction, but more recently has trended off. Now, I think one of the reasons is because of oil, gas, shale production has significantly influenced this. But nonetheless, there are anecdotal stories out there with respect to production, in fact, coming back to the U.S. Low oil, we all know about the oil story. I won't dwell upon it, but the other story, of course, is low interest rates. And we've had unprecedented low interest rates for the last 7 years, actually probably closer to 8 years now. And the question is, will that continue and how long? Looking at profits, 75% of the profits earned over the last 6 years, 5 years plus projected for 2015, been earned only in 2 areas, North America and Asia Pacific. If you look at the industry overall, the story is a great story. $86 billion of earnings over the course of 2010 through projected 2015 versus $48 billion lost in the prior 10 years. But when you look to the right-hand side, you can see that North American carriers earned $27 billion of the $62 billion of the last 5 years and are projected to earn $13 billion of the $24 billion the industry is projected to earn this year. Asia Pacific represents the lion's share of the remainder, roughly $28 billion, but if you look at the projected 2015 earnings for Asia Pacific carriers, it's an anemic $4 billion versus North American carriers of $13 billion. You look at Europe, only $10 billion earned over the last 15, 16 years. That's obviously an unacceptable return of capital earnings for the capital deployed for European carriers. Middle East carriers, obviously, falling behind that, Latin American carriers struggling. So, what's really happening here? Well, consolidation really has helped the North American carriers. Why? Well, they're able to get together. How do they get together? They had to restructure themselves, with the exception of Southwest. They had to restructure themselves in order to be compatible partners. And that's a theme that seems to be lost around the world, that you actually do have to fix yourself before you consolidate. So what's happened? North American carriers have the top 4. In 2004, had 57% of the market. They now have 79% of the market, up 22 points. In Europe, the top 4 carrier groups at 45%. They're only up 47. Very modest consolidation in that period of time. And Asia is actually being fractured. The top 4 carriers today control only 27% of the market, down 5% over the last 10 years. What's the other theme? Obviously, low-cost carrier expansion. What's going on there? Well, low-cost carriers expanded, obviously, significantly in North America. And this includes all carriers that some might argue, aren't fully low-cost carriers in the sense that increasingly their price and their products look a lot like the larger carriers. But that share has gone from 19 points to 32 points, up 13, but only 5 in the last 5 years. So obviously a slowing trend. But if you look at Europe, Europe also was in the same position 10 years ago, with 19% of the market controlled by low-cost carriers. Today, that's 40% and growing. Indeed, 9 points versus 5 points change in Europe versus the US. And obviously, in ending point, that's 8 points higher than the US. Asia is obviously later in the cycle, up from 4% to 19%, but less strongly growing now than it was in the prior five periods. The result of that is that the North American carriers the last 7 years have only grown 5% in total, whereas European carriers have grown 23% and Asian Pacific carriers 46%. When you look at that relative to GDP growth, North American carriers' capacity did exceed GDP growth, but by modest amounts, and I realize you can't read this, so I'll read them off. So from 2004 to 2008, GDP in North America went up 2% compounded each year against 2.2%, so very, very close alignment. Capacity then expanded a little bit faster at 1.6% from 2008 to 2014 against 1% growth of GDP. But in Europe, it's an unbelievable story. 2004 to 2008, GDP grew at 2.9%, but capacity grew at 7.3% each year. More recently, capacity growth has been abated at 2.8% a year, but GDP is only up 0.3%. So it's small wonder that there are significant profit problems in Europe. In Asia, much more balanced than Europe, but not as balanced as the US. Capacity grew at 6.8% in the 2004-2008 against 5.2% GDP. But more recently, there's a 3-point difference in the last 5 years, last 6 years, with GDP on average growing at 3.6% against 6.5% for capacity. So what else is happening out there? Well, there's global consolidation. It's happening at a faster pace. Everyone knows about global alliances, but what doesn't get reported very much is the impact of joint ventures. And these are most, not all, of the joint ventures that have been recently put together. In fact, JVs, we would argue JVs are supplanting global alliances. The template was set many, many years ago with the KLM Northwest joint venture agreement, which was the envy of the industry and was a key component of the merger ultimately between Air France and KLM and Northwest and Delta. Today, if you look at North America, North Atlantic, 85% of that capacity is in global alliances, but 75 points of those 85 points are in joint venture agreements. 85% of the 85% is in joint venture agreements. In Asia to Europe and North Pacific, those joint venture numbers are much smaller. We expect those to be expanding very, very significantly. And in fact, a lot of our advisory work around the world is to help airlines understand the impact, the importance, how to negotiate those kind of agreements, and its impact on them and others to the extent that they're not part of it. If you look at European airlines that are not part of the joint venture agreements, they have been relegated to the world that existed back in the 1980s. They're now interlining it or under SPA, special prorate agreements, which give them far less share of the revenues and profits of that capacity. So small wonder that the mid-size and smaller carriers that are trying to conduct global traffic have less opportunities to earn money. This is a big feature of today, and I put only one slide in here on order positions, and it is really to just put some perspective on it. Obviously, everyone knows that there's $1 trillion plus in list price of aircraft out there. We are a significant advisor. We've done over $300 billion of aircraft advisory work for airlines. We also do a lot of advisory work today for OEMs in terms of helping them think through the processes and how airlines think about evaluating aircraft. And you can see here, and if you go back in time, I'm one of those people who are old enough to go back in time, we all thought about the cycle as being 7 years. It was within a year or two, it was always 7 years that something bad happened. Well, as you can see, it was a shorter time period in the mid-90s to 2004. If you look at it from the 90s to 95, it was another 7 year. Then we had a 3-year growth, and then we had, obviously, 9/11 fall off. But since then, we've had 13 years of expansion. And there's nothing, notwithstanding the things that I'm telling you today, there's nothing on the horizon, I think, that would suggest that production will abate anytime soon, that demand will fall off, or the backlog will shrink sufficiently to see a downturn. And indeed, we look very well poised to see something that's 20 years or longer. But there are issues that we need to focus on, which is what's happening around the world with growth, LCC expansion, and the other traumas that airlines are going through. Just a moment on freighters. I think everyone knows this story, but this is a very dramatic depiction that shows that 78% of capacity coming on between 2015 and 2019 is in the belly of aircraft, as opposed to dedicated freighters. We do see significant demand for dedicated freighters, particularly in express operations, particularly in Asia, China, India, and Southeast Asia. Rates, well, I mentioned at the early part of the address, we've had unprecedented low levels of rates. I think they've been unprecedented for the last 80 years. So when the rates do rise, it's a different world than the one we've been in, and we need to prepare for it. I'm not that concerned that it's going to go spike up very soon. I think the world, for reasons I've outlined, has substantial issues associated with it. It'll be hard for the U.S. to push rates up too high, but nonetheless, they are going up. The jobless figures for the U.S. announced Friday, blew well past the projections. The Fed is on record as expecting to raise rates in June, so I think this is a world that we need to get reacclimatized to. For the industry, we're doing better, but we're still short of the ROIC goals that needed to replenish capital for this industry. And this is a theme, again, we're doing much better, but it's a theme I really want to then expend the rest of this presentation on. How do we get there? Well, I think one of the ways to think about that is to look at what's been done well, and particularly the US carriers, but other carriers around the world as well. And this is when we talk to a more airline-centric executive group, we focus principally, obviously, on this area, which is network planning, fleet optimization. Just to give you an idea, when we do a campaign, aircraft campaign for an airline, we can do up to 600 different iterations over 20 or 30 years, involving not just that airline, but all of its direct competitors. Doesn't mean we're going to get it right. What we're showing are relationships, because ultimately in selecting the right quantity of aircraft, the right types, what you want to understand is how they perform for that airline vis-a-vis its competitors. In an airline business, in the global business where we're trying to eke out 4 or 5% margins, getting it right on an aircraft order really means a large part of the future of that airline for the next 15 or 20 years. So this is a very important part. Fleet upgrades and product upgrades are obviously a theme. U.S. carriers, North American, I need to add Air Canada to this, are all significant parties making now investments there. Pricing, product strategies, ancillary revenues have obviously been a key component to profitability for airlines around the world, certainly significantly for North American carriers. But the big story is ultimately on the left-hand side, which is cost containment, understanding the cost, getting a hold of those. And that was the major theme and direction that we were a heavy participant in advising such airlines as Air Canada and Northwest Airlines, US Airways, and others to help them prepare for merger. So one of the startling things about this is the carriers that actually went through some form of either judicial or out-of-court restructuring, such as Air Canada, JAL, US Airways, American, Delta, Avianca, United, through the court system, or things like airlines like Frontier, more recently Monarch, Iberia, Swiss, they all went through some level of traumatic restructuring that was to address things like labor, network, capacity, fleet, and other costs. I want to use two case studies of this collaboration, and I want to just stop back to where I was before on that slide to say all of those required a lot of people in the room or your colleagues to interact with us or others who were helping those airlines get through that process. Very difficult process, a very necessary process, and one that ultimately has rewarded the industry with profits. A majority of the profits today, or at least arguably close to a majority of all the profits today, are earned by carriers that went through some form of traumatic restructuring. That doesn't mean that everyone out there has to go through it. It is simply to say that everyone out there that isn't earning a profit needs to address significant parts of their system, likely out of court. And that means through a consensual process involving people here. Two case studies recently. In 2013, we were approached actually by an OEM, Bombardier, who had a regional client called Air Nostrum based in Spain. They had a code-share agreement with Iberia that was coming up. They were running out of money. Iberia was unwilling to extend their code share. They had tremendous amount of liabilities coming, and they simply had no cash. They were close to liquidation. So unprecedented in our 20-year history, the OEM actually retained us to represent the other side. They actually paid our retainer fees. And we went through a process of working collaboratively with Bombardier, who was the largest creditor and gave the most concessions, along with other lessors. The ultimate result of that was we were able to restructure the liabilities, we were able to right-size the fleet, get the right regional aircraft in, turn a profit, raise capital, ultimately provided by the most significant shareholder after running a process with private equity. That led to securing a long-term new agreement with Iberia, which we advised for about a year on. Very difficult process, but ultimately successful, thereby avoiding liquidation and substantial losses from Bombardier and others. We believe that this is a template, one of the templates for working together in the future. Another case study was Monarch Airlines. Frankly, I didn't know Monarch Airlines at all. I never met anyone there. Our team, at any time we have about 90 engagements around the world, so I work on 2 or 3 engagements of 90, so I don't see that many of my clients or our customers. We advised them on an order for aircraft, and shortly thereafter we're informed that they were running out of capital, and their multi-billion-dollar Swiss shareholder had chosen to depart ownership. The result of that was that we had to scramble. They only had 8 weeks of cash. We had to, in those 8 weeks, get enough confidence from the credit card processors, from the existing shareholder and others, to bring more capital in, to buy time, and in 12 weeks did a full turnaround that avoided a catastrophic loss for lessors and banks and others. It wasn't easy. Labor incredibly came along. They did about a 40% reduction in total compensation and benefits. We eliminated some 700 million pounds sterling of liabilities that were on and off the balance sheet, including a very large pension plan. We worked very cooperatively with the CAA, who are a very significant partner with us in pulling this about. We ran through a private equity capital process that ultimately raised 125 million pounds sterling. And this airline today is profitable. Would have been profitable even without a drop in oil, but luckily we had gotten rid of all the hedges, so they're measurably profitable today. The point of all this is that in a competitive world that's moving very fast, we need greater collaboration. Airlines need to focus on, managements need to focus on best practices and adopt state-of-the-art tools and know what they know and know what they don't know, and bring in help where possible. OEMs, we would argue, need to be much more collaborative partners with the airlines in recommending to them what they should be pursuing. Similarly, we would argue that lessors and banks could be a lot more activists through your credit process in identifying what are not best practices at the airline. And I'll give you a simple example. We would say 90% of the airlines out there have flight profitability systems that are Excel-based, inappropriate, inadequate, And so if you're relying on those for your credit process, we would say you're relying on a foundation that's made of sand. Finally, we'd say advisors out there ought to be held to much higher standards than they are today. We hold ourselves to a standard of 15 to 50 times NPV, return on our fees for our clients, and we tie our fees oftentimes to those performance. We also try to get them to call our references, which 1 out of 5 do. This is a world that just good enough isn't good enough. We would say we all need to step up the game and figure out how to collaborate in a better way, figure out the how and when in a much earlier time frame, so that when we are collaborating, the client, the customer, isn't being willed into the emergency room, but rather much earlier, 3, 4, 5 years earlier, where there's an opportunity to preserve capital, preserve value for lessors and others. With that, I have about 4 minutes for questions. There are some mics around the room.
Please raise your hand and we'll come to you.
I answered everything there is to know about the airline business. I'll have to get one of my Seabury colleagues to ask a question. They probably want to know what the bonus is for the year.
Here we go. Stand up, David.
Andy Carlisle from Investec.
Hi, Andy.
Based in Ireland, obviously Aer Lingus going through a very long process at the moment, very political process as to whether it will be consolidated into an IAG or remain independent. Do you see future for those small peripheral airlines in Europe outside those major groupings, like TAP, like Aer Lingus and so on?
It's a good question. It's a tough question. I think that airlines can find themselves in a niche, and profitably operate in that niche. Monarch, I skipped over the point that we walked in, they had expanded about 30 or 40% of the capacity. That 30 or 40% all lost money. So it was an easy fix from that standpoint. Aer Lingus obviously is profitable. I think that status quo isn't acceptable. So if I were advising Aer Lingus, which I'm not, I would say that they should have a strategy that goes in one direction or another, that they are aggregating into a bigger group, or they're aggregating with others to create yet form an additional or alternative alliance to support where they are. Yes?
Bill Mastoris with R.W. Baird and Company. My quick question has to do with, you mentioned competitive labor costs as part of the restructuring process, yet we've seen some pretty healthy increases in labor contracts. Still believe they're competitive, or have we taken apart some of the benefits of restructuring with some of the more recent, if you will, agreements or tentative agreements?
Well, obviously, they're going up. So are they competitive? Well, they're competitive vis-a-vis most of their peers still. Will they get back into trouble in 5 or 6, 7 years? Well, there are a number of things that have gone on, and I'd say one of those is the aggregation of so much capacity in so few airlines. Puts the airlines actually in a better position to withstand labor pressures in the future. So I think they've taken away the excuse. They've adopted a partnership relationship with labor. We'll see how it plays out in 5 or 6 years from now. Time will tell. But 5 or 6 years from now, the likes of American Airlines and Delta and others are in far better position to hold the line at that point than they were 10 years ago.
Aaron Karp with Air Transport World. What are the consequences of the joint ventures supplanting the alliances? What does that mean for the future of the alliances?
Well, I'm sure the alliances themselves, the global alliances, will continue. They were founded by the very people who are promulgating the major joint ventures, and they serve a purpose. But the nature of what you benefit, how you benefit within those global alliances is a very detailed negotiation by carrier, by alliance. And much like everything else I've talked about today, it's not for, we would recommend an airline try to get good, competent help in that field because each deal is different in each alliance. Well, I am exactly 0.00 times, so thank you all.